This is Fenwick Huss. I'm Dean of the Zicklin School of Business, and it's my great pleasure to welcome you this morning to this webinar. The Zicklin School of Business is celebrating its centennial this year. We've been involved in business and management education for those 100 years, and two words really describe the Zicklin School. The first is tradition, and the second is innovation. The tradition is what we've been doing those 100 years, which is being a vehicle for social mobility, launching our students, often first generation to college, into their very successful careers. But in order to do that, we also have to be innovative. And recently, I would say, in the current era, we're being innovative under pressure, and we're having to adapt very rapidly. But we also recognize that that's also what's happening across the economy and across sectors. These conversations and these webinars are to give all of us insight on how those transitions are occurring. It is indeed a look at what might be the new normal in business. Helping me today from the Dean's office is Gwen Webb, who will be monitoring the question and answer period. And we're delighted to have as our experts today, first Linda Allen, who's the William Aldinger Chair in Banking and Finance. And she is credited with the title of today's session, which is Start the World I Want to Get On. In other words, imagining the new economy. And in conversation with Linda is Larry Zicklin, former chairman of Neuberger Berman, the school's benefactor, a great friend of the school, a professor in our honors program. So I'm sure we're in for a very interesting and lively conversation. And Larry, thank you. You may begin.
Thank you. And just for the benefit of our audience, you should know that Linda and I are old friends, and Linda has agreed to go easy on me. So be aware. Linda, I know you work from models, and I'll get to the models in a moment, but from 35,000 feet, tell me, what are you seeing now in terms of inflation and future business conditions?
Okay, so first I'm going to follow up what Larry just said. He and I are used to lively conversations in which we're very open and we disagree with each other a lot. So let me open up with a disclaimer that all of the opinions that I'm going to state here are my own. They're not the opinions of the School of Business or Larry Zicklin. And so buckle up, you're in for a bit of a bumpy ride. So Larry asked me for the 25,000 and the 35,000 foot view. And to a very large extent, it's in the title. The title to me tells me that we can restart the economy, that we can restart the world. And as Larry has said, my model is showing me that there is some potential reason for optimism. But even before we get to the economics, I just want to say a word about my view of my fellow citizens of the world, if you will, because we are, in some sense, thinking very poorly of one another to think that we can't be responsible citizens in the event that the economy and the world is reopened. I believe that we can, and I believe that we should. And so if you want me to get to the reason for that, I'll go down that road right now.
Well, I believe that also. Then again, I've walked in Central Park, and I figure it only takes one person without a mask to get me.
Right. And certainly, if I finally get to go to my hairdresser again, I won't enter until I see that everybody's wearing a mask, and I won't go out without my mask. I think that we should take prudent steps. But I think life is all about the balancing of risks. And unless we learn that we are going to have to live in a world in which risks are part of life, then we're never going to get out of this. And that's my fear.
Okay, since neither one of us is an epidemiologist, let's go to the economics.
Okay.
What are your models showing us in terms of business and maybe in terms of the markets?
Okay, so this is not my model. Actually, it's a model that I did with two excellent co-authors, and they're the ones who are doing the heavy lifting in terms of the econometrics. It's Professor Yi Tang of Fordham University and Professor Turan Bali of Georgetown University. And in this paper, we looked at how the financial community is important to the real economy, the connection, if you will, between Wall Street and Main Street. And we are interested in how we can look at some metrics of the financial community to understand how the macroeconomy is going to perform. So before we even get into the technical details, and let's again stick at a very intuitive framework. So let's use a medical analogy, okay? Let's look at a medical analogy as if the economy was the human body. And to keep the human body healthy, we need circulation of the blood flow through the organs. And similarly, to keep the economy healthy, we need a circulation through the economy, but the blood of the economy is capital, or money that flows through the economy, from savers who have excess cash to investors who invest that money in building factories and buying houses and discovering the cure for COVID-19 and all the other activities that we engage in. Now that circulatory flow is in some sense managed, if you will, or helped out by the financial system, because the role of banks and other financial intermediaries in this global economy is to facilitate that capital flow. And just like blood flows are obstructed in the body if there is plaque that keeps the arteries from being fully opened, well, the role of the banking community is to keep the arteries open. Now, how does it do that? The banking community does that by absorbing risk from the system, taking on risk, thereby allowing capital to flow freely through the system. And this is really the crux of my model. And to really understand the intuition behind it, think back to April 20th. And on April 20th, we saw the price of oil fall to -$37, unprecedented. What's up with that? A price that's negative. What does that actually mean? Well, as we know, when the world's shut down, the demand for flying and driving and all the other activities that utilize oil went way down. But the supply continued to at its normal level. And so we had each and every day excess amounts of oil being pumped out into the market. Nobody was buying it, so it was stored in storage tanks and tankers on the high seas all around the world. As those storage facilities started to fill up, there was no room for the excess oil. So sellers of oil actually started to pay buyers to take the oil off their hands. Now, what does this have to do with the macroeconomy? Banks and other financial intermediaries have a limited capacity to absorb risk. Their storage tanks of risk get full. And when the storage tanks become close to capacity, then they can't take on additional risk. And that will then stop or make the flow of capital more and more sluggish through the economy. So that's why we found, and we estimate this model for almost 50 years, where we found that whenever the storage capacity in the financial system gets close to being full, that we can see a macroeconomic downturn within 6 to 8 months, meaning that the financial system isn't keeping the arteries of capital flows clear. That's the intuition behind our model. And our model essentially measures the amount of capacity left in the risk storage tanks in the global banking world. Larry, is Larry still here? So let me go to the model. Let's actually take a look at it, because as we know, a picture is worth 1,000 words. And let me get this picture up. So we should all start to see my slide here. Okay, does everybody see this? I'm not seeing it it's on my screen, but I imagine it's on your screen as well. So, so you can see from this screen that this is, we call our model the CATFIN. So CATFIN measures, as I'm saying, the amount of risk in storage facilities throughout the world. And you could see by this level amount, this beige area, that's what we found over decades of analysis of the data, that this is the capacity, if you will, the threshold, we're calling it. We're calling it an early warning threshold. And so when, and the blue line is the amount of risk in the financial system. Whenever you see the blue line go above the storage capacity of risk, you see that we are now finding that the financial system is no longer able to keep absorbing enough risk to keep capital flows freely moving through the world economy. And the finding is that a recession follows. These gray bars are recessions. So what we're seeing is that whenever the blue line goes above the storage capacity of risk, then we're forecasting a macroeconomic downturn. And as you can see, we have forecast them over the years, over the almost 50 years of analysis. As you can see, and this is, of course, this is where we are now in 2020. This highest peak is in 2009. You can see that the current peak is slightly lower than the max in the 2008-2009 financial crisis, but higher than we were in September of 2008. So what this is saying is that we are looking at a serious recession as a result of the coronavirus pandemic. Now, this, you don't need a PhD in finance to tell you this, obviously. This is clear. So let's Larry, you're back. So let's try to drill down into this. And this is where we now highlight the evidence from February 2020 to, we've updated until the week ending May 8th, 2020. And as you can see, we first cross the storage capacity, the threshold. It was the week ending February 28th, 2020. And here's where we started to see during the month of March, huge increases in the risk factors and the signal that the economy was going to be entering a serious recession. Interestingly enough, though, April 9th, the week ending April 9th, 2020, look at what happened. The risk levels went down below the threshold level. They bumped up again, and now they're down below. And this is the reason for my optimism, if you will. I think we have the opportunity, if we restart the economy, to avoid some of the worst of this recession. The global banking system is capable of absorbing enough risk at this point, but I think we have to get started soon.
So can you hear me okay, Linda?
Yes.
Okay, so can you answer a question? Since this model is heavily dependent on stock prices, first of all, what stocks are included? Is it only financial stocks? And how broad is your definition of financial stocks?
Excellent. So this is based on stock prices. There are other variables in there, but the main input into this model is stock prices. And they are, as you say, stock prices for financial firms only. The interesting, and we define financial firms in very broad terms. So of course we have banks there, but we also have insurance companies. We have mutual funds. We have hedge funds to the extent they're public. Anything that is financial, as financial intermediary is included here. And the idea is that the financial firms have a very special role to play in the economy, in this risk absorption capacity that they have. We actually, in the paper, we conducted, a placebo test. using what we called fake banks. Now, this paper came out in 2012, long before we knew about fake news. So we were talking about fake banks then. And these fake banks were large firms that were very similar to the big banks. And we tested to see if their stock prices had any predictive capacity, and they didn't. So it shows that there's something special about the financial firms, yes.
No, but I think you would agree that over the long run, stock prices have predictive ability.
Correct.
And probably we could agree that over the short run, stock prices are random. Things that happen today, tomorrow, and next week may come about for all kinds of random reasons.
Well, I'm not prepared yet. I'm not prepared to sign on to that, since that assumes that markets are more efficient than we generally believe. We know that there are concepts like momentum and other anomalies that academic finance people like me have trouble understanding. But clearly there is a forward-looking aspect of stock prices, which is what we're exploiting here.
And how far forward is that forward?
Well, again, in my model, in this model, we found a window of 6 to 8 months forward. After that, it had no more predictive power.
So if I told you that next week the financial stocks would rally 5% and the week after 5% more,
I wouldn't believe you because you don't have a crystal ball. But yes, I'm sorry. Go ahead. Yes. I'm sorry, Larry. Did you freeze? Uh-oh. Are you back? Uh-oh, hold it. I'm going to get him one line. Hold it. See, that's what happens when I argue with Larry Zicklin. A higher power comes down. Yes, okay. Let me put it on. I'm putting it on speaker. Okay, we're going to continue this on the phone. At least we see him there. Can we hear you? Can you hear him? Let me see. Can everybody hear him? Matt, are you? Can you tell me if Larry can be heard?
Not well, Linda.
Not well. Okay.
This is the question I want to ask you.
Okay.
You can repeat it.
I'll repeat his questions. Okay, go ahead.
If I told you the market was going to rally 5% next week, 5% the week after, what would that do to your model?
Okay. So Larry's question, before I rudely interrupted, excuse me, is if he told me that the market was going to rally 5% this week and 5% the week after, how would it affect my model? And again, it wouldn't matter if it was a broad market rally necessarily. What we're talking about are increases in the stock prices for financial firms themselves, for banks and other large financial firms. But if we saw that increase, then again, with the caveats that these are extreme. Well, let me back up a second. I think that this is really helpful because when we talk about what the model is trying to do, we're looking at the entire range of all the prices at any point in time. And so there are stock prices that are high and there are stock prices that are low. Now, our model is dealing with the lower stock prices. That is the extreme loss end of the distribution of prices. That's really where the name comes from. CATFIN comes from catastrophe in finance. So we're examining how bad it could get. How much risk is there in the system, and how bad could it get in the system? And our model shows this result if those worst performers are going to be doing very badly. If, on the other hand, what you're positing, Larry, is an increase in stock prices over the best performers, but not the worst performers, then that would not affect our model. So in some sense, what we're really zeroing in on is how bad can the financial stock prices be for the financial firms, because that tells us about catastrophic risk in the system.
Linda, isn't it true that bank stocks have underperformed the market in the last few weeks, few months?
No question. And that's an indication of their risk exposure. And here you see it here in this figure. And that's in some sense, that we would expect that, because they're being called upon to absorb risk. And if their risk capacity is already depleted, then they can't absorb additional risk. So there's no doubt that that would affect the matter. But we're not comparing how the stock the banking stocks perform with regard to a broad index. What we're looking at is how we can explain the cross-sectional at any point in time, all the range of different stock prices for all of these different financial institutions. And then we're zeroing in on the worst performers.
Linda, last year, and don't hold me to this, toward the end of last year, there was great fear because there was an inverse yield curve.
Yes.
How did your model respond to that? Because there was a lot of bearish sentiment and people talking about in an inverse yield curve, the market's going to get hurt.
Right. So that was when we first started to update our model. So we had a press release that came out at the beginning of September in 2018, where we updated the model. And in fact, so you might see it. Let's just back up a second. So let's go back a page. What's my system not moving? No. Okay, wrong way. Okay, so if you can see back here, this is where we were around, I'm highlighting where we were around in September of 2019. So what we found at that time was that fears about, excuse me, the inversion of the yield curve were very overstated, that there was not a forecast based on our model of a downturn in the economy within the next 6 to 8 months. So, and of course, we were found to be correct, because the economy did do very well and continued to chug along until the coronavirus hit. So what we found back in the end of August of 2019 was that the risk-taking capacity in the financial system was sufficient to allow the financial system to continue to allow the economy to grow and allow the capital to circulate throughout the world's economy.
Linda, you know, we all talk about new things, and this time it's different. One of the reasons this time may be different is that the Federal Reserve is backstopping the economy to an extent we have never seen in our lifetimes.
Yes.
What does that do to your model?
Yes.
And what does it do to the system, frankly?
Okay, let me be honest. I'm afraid that it might invalidate my model. So that might be the end of it, because this is all predicated on the assumption that it's the financial system that's required to facilitate capital flows around the world, and they do that by absorbing risk from the system. What happens when the financial system doesn't do that? When the Federal Reserve, and indeed the US Treasury, is the lender of last resort, not just to the financial system, but to the corporate system, the general economy, the government, even individuals, small businesses. Now everything is run through the government. I'm afraid that Bernie Sanders might have won, because to a very large extent, we have moved from a private sector economy to a government backstop economy. And that is going to have long-term repercussions. Let me say this, and I think, and again, not to be too much of a skunk at a garden party, and clearly the Fed's intervention was viewed to be important in calming fears about the economy. As we have moved through potential problems, and let's say you're asking about last summer of 2019, when the yield curve inverted and the Fed immediately reversed its tightening stance to lower interest rates because of the fear of a recession. we have begun to believe that it's the job of the Fed to prevent any economic downturns. I am afraid that we are addicted to Fed intervention. And without that fix, economic activity will be suffering quite a bit, because it's a drug addiction just like any other, unfortunately.
And how do you see this playing out in the economy over the next 2 years?
Well, I think that if we do restart the economy, and as our model is suggesting, we do start economic activity, and we have a sort of V-shaped recovery. There is so much money in the system. You know, of course, I'm sure you know that lower wage employees are making more money, considerably more money, on unemployment insurance than they earned when they were working. There is a lot of stimulus out there. When we restart the economy, my fear is that that's going to fuel an inflationary spiral. Now, of course, we've been predicting inflation for a very long time, and the Japanese have us beat on this in terms of decades of evidence that should have forecast inflation, but did not. But I think that the amounts of stimulus are unprecedented at this time. And my fear is that we will see inflation. I'm more worried about inflation than recession in reality.
So given your fear, let me ask a question I asked last week, and I'm interested in your take. Given your fear of inflation and where interest rates are today, why isn't the government floating 50 and 100-year bonds?
And I think that you are absolutely right about this. Certainly 100-year bonds. It's interesting to note that the Treasury has started to shift the maturity of their offerings to 20 and 30 years, but not to 100 or 50 years. Now, and it's an interesting thing, because in some sense, there is a reason for them not to do that, because the role of the Treasury is to facilitate the financial markets. And the question is there demand for that long-term paper? Is there demand for 100-year US Treasury bonds? So to understand that, and here, let me show you another slide. And this is from my colleague at Columbia, Professor Gert Beckert, who sent me this updated version of his model. And their model looks at flights to safety. So what does that mean? Flights to safety are when the individual decision makers are so concerned about any investment in any financial security that all they want are the safest instruments around. And we all know the safest instruments around are US Treasury obligations. So what this is looking at is updating their model from January 1st, 2020 until April 21st, 2020, and trying to ascertain where in the world there would be demand for these long-term US Treasury obligations as fueled by flights to safety. They look at these countries. I think there are 22 countries in this list. And what this graph shows is the number of countries in which there is a flight to safety, and they did it on, I believe it was a weekly basis. And what you see is that, of course, this whole area in the middle that's very high shows that during the height of the panic associated with the pandemic, we see that most of the countries were exhibiting this flight to safety phenomenon. That is, that there would be ample demand to buy up 100-year US Treasuries. That has eased somewhat as time went on, as my model shows as well. So I'm not so sure how successful such a bond issuance would be, but I don't see why they don't try it.
As I pointed out last week, in January, where there was not much flight to safety, Georgetown floated a 100-year bond.
Right, yeah.
They made it.
Yeah, right. There's
Why
absolutely
wouldn't I think that this is, to me, this looks like a coincident indicator in this sense, that when stock prices go down, there's a flight to safety. When stock prices go up, we reverse that trend. And I would expect now that stock prices have rallied so that your indicators would show exactly what they show. But if stock prices for some reason turn down, the reverse would be true.
Right. So, this is not simply, the alternative is not simply stocks, clearly. There are other financial instruments out there that investors can flee to, if you will, most notably bonds, corporate bonds, municipal bonds, and the like. So the model is a little bit, this is not my model, but their model is a little bit more sophisticated than that. Though, of course, there is an opportunity cost question. When financial markets are doing great, then you don't want to lose the yield you can have from investing in stocks or bonds or whatever by holding boring old US Treasury obligations. What this is showing, though, and it's consistent with what we got in our model, is that there is this bulge, if you will, that was basically the month of March, in which there was great fear throughout the world. That would have been the time to float those 100-year treasuries. We missed that boat, but I don't see why the Treasury doesn't explore that opportunity now.
Okay, one.
Hold it up. You froze again, so tell me the question. Larry?
I happened to read in a paper that WeWork is no longer paying its rent.
Yeah.
WeWork is either the first or largest lessee of space in New York City. The second or first largest lessee, the alternative, is JP Morgan Chase. It seems to me the world is such that JP Morgan Chase might not need as much space as it used to have over the long run, because they don't need as many branches.
Right.
Does that forecast some real problems down the credit line for everybody that owns the mortgages?
Okay, let me ask Larry's question. Yes, I will. So Larry notes that WeWork has stopped making its rental payments, and I should interject, they're not the only ones, and they are the largest renter of space in the New York City area, followed by JP Morgan Chase, both of which will most likely, when we come out of this, when we restart the world, both of which will probably be demanding far less office space. And that should have a dramatic impact on the real estate market in New York City and in other environs. So how does that affect the likelihood for, let me add, the real estate market, and then for credit risk, as you asked, Larry, if that's okay with you, okay?
Absolutely.
So let's first talk about the real estate market. And let me also confess to perhaps a mismarketing, if you will, of our title. We talk about imagining the new economy. I don't presume to imagine the new economy, because I don't think that we can imagine how the economy will look like once we open it up again and people innovate and we see the creative juices of individuals, businesses, governments working in the new environment. So will office space be used the way it was used in the past? Most likely not. But will that mean that we're going to have a drop in rentals and a complete recession in the real estate market? I'm not prepared to say that. It's possible. I certainly understand the likelihood that it could happen, but it may very well be that we are going to be demanding more personal space in our offices, and therefore, indeed, we will have to house fewer people in bigger areas, and that might even create a bit of an offsetting boom in the demand for real estate. So I'm not prepared to say that I'm seeing a complete drop in the bottom of the rental market in the New York City or other areas like that would have.
But
Yeah.
just to stay in your wheelhouse, Linda,
Yes, please.
do you think branch banking will ever be the same?
Yes, yes.
Retail branch banking, obviously.
Right. Well, I think that banking was disrupted even before the pandemic.
Absolutely.
So I have a paper that I'm going around the world virtually presenting, where I have several of my co-authors. Yi is on that. Yi Tang is on that as well. Yu Shan is on that as well, and Alev Yildirim is on that paper as well, where we look at disruption in the banking sector by fintech banks. Now, of course, we were supposed to have a fintech conference this week on Thursday in Baruch, which is of course canceled because of the pandemic. But at that conference, we were looking at how disruptive fintech is to traditional banking. Now, I'm not talking about mobile banking now, because that's not disruption as far as I'm concerned. That's just another delivery system. And if you're as old as I am, you remember back when the banks were moaning and groaning about ATMs as being disruptive to the banking model, because we won't need tellers anymore. Obviously, we've been able to overcome that, and banking hasn't changed. Indeed, banking hasn't changed in 100 years, fundamentally. My colleague at NYU, Tom Philippon, has a very interesting paper which shows that the unit cost of financial intermediation has stayed steady at around 2% for more than 100 years. Can you imagine that? The financial industry has bypassed not only the internet revolution, but the industrial revolution. We're still doing banking in the old way. We're using what I call a dealer approach, meaning that the bank steps in, uses its balance sheet to absorb risk, and then goes on and creates this process of financial activity. Fintech firms don't do that. They don't need to absorb risk. They can facilitate financial market activity without absorbing risk. And that is really going to revolutionize banking. So it's not a matter of physical space. It's a matter of technology.
One of the questions I always ask my students in class is, how many of you have visited a bank in the last month?
Right.
I'm shocked that you get one or two.
Yeah.
Everything else is done digitally.
Right. I'm surprised that you get one or two. I would think that you get none.
Right.
Even old codgers like me don't go to the bank anymore.
Well, that speaks about space requirements. Gwen.
Yes.
Oh, yes.
There are quite a few questions, and I'd like to start with, there's a lot of interest in the model itself. One of the questions is, how do you calculate risk? What data is going into the model? And another one very similar is asking, since the model is based on historical data and we're dealing with a disruption to the economy that is so unprecedented and so unique, whatever data you're putting into it, they're historical data, and how can those really be relied on to predict the future?
Okay, great. Thank you. Thank you so much for that question. So, as Larry has stated, the model is really driven by stock prices. So stock prices, we know, are indicators of how much investors are willing to pay for ownership shares in companies. And as such, we know that the prices are very much forward-looking, in the sense that we're not paying for past performance, we're paying for future performance. So in some sense, we're relying on stock prices as a market consensus of where we are at this point looking forward. So it's really important in our model to keep updating the information. As you see, things are changing all the time as the market's consensus forecast changes with the stock prices, or how the stock prices are moving. but just to get into a little bit more of the weeds of what the model is. And I started to talk about it, but I really think it's really an important idea here in response to that question. We don't really look at stock prices vis-a-vis the market. We're not, equity analysts. I'm not on MSNBC or any of those talking heads doing any of that stuff. What we really are doing is taking all of the financial firms at a given point in time. These new results are weekly. And we look at companies that do well, companies that do poorly, and companies that are in between. And we look at what we call the entire distribution of stock prices from good, bad to indifferent. And we look at where that entire distribution is. That is the entire cross-section of all the prices for financial firms out there. And you can imagine this as if when the market is very pessimistic about the future opportunities, that whole distribution shifts downward into the bad return state. Whereas when the market is very optimistic about the future, the whole distribution shifts upward to the good return states. What we look at is how that shifts occur. So we don't look at any one particular stock price or even a portfolio of stock prices. We look at where the distribution of all financial stock prices are at any given point in time. And that gives us what we found to be a very good measure of that, what we call the systemic risk in the economy, in the financial sector, which limits their ability to continue absorbing more and more risk and keeping the economy moving.
When you look at that distribution, do you focus on either the right-hand tail or the left-hand tail, or is it the full distribution that you're really looking at?
Right, so we do it, and this is the stuff that academics, we love to talk about, but clearly we used, it's very robust. We estimated it in 6 different ways, of parametric and non-parametric, but we did estimate it using a full distribution, using up to 4 moments that included the mean, the variance, the skewness, and the kurtosis.
I guess we'll have to move away from the details of the model, but these are published articles. Are these readily available through SSRN?
Yeah, so this is out in the Review of Financial Studies in 2012. This is where the paper was published.
Okay, I think that maybe we can provide some of that information to participants afterwards. There are a lot of questions here. Just to pick another couple at random. One of the things that you've said is that the Fed is basically taking over the role of the banks as intermediaries that guide private sector capital to the best possible uses. Is the Fed going to do, this is actually, there are a number of related questions. Will the Fed do this differently than the banks? Do you think this is going to be a permanent change? If it's a permanent change and it's really different, what will be the long-term impact on the efficiency of our economy?
Right. Well, certainly, I hope that it won't be a permanent change, but I fear that it might be because, as I said, the market has become addicted to Fed support, such that whenever there's a blip, as we saw last summer, a slight inversion of the yield curve, there was hue and cry for Fed protection, for the Fed savior. So I'm worried that it's going to be permanent. I would caution that it should not be permanent. I think that it is quite dangerous if it is. And the reason is exactly as you say, Gwen, that the Fed will not do this allocation, perform capital allocation functions as the private sector does, because they don't have a skin in the game. They have no skin in the game. We saw in the run-up to the financial crisis in 2007 that a big problem associated with the financial crisis was that banks and other financial intermediaries had no skin in the game. That is, they were writing dodgy mortgages to investors who had no business taking out mortgages, were not creditworthy, and they did so because the banks knew they were going to sell those mortgages into securitization. Wasn't their problem, right? The issue of having a financial stake in the outcome is critical in determining better business behavior. And we know that, and that's why all of the changes post-crisis have really been to try to incorporate that into the financial system. Now, the Fed, by definition, has no skin in the game. It does not have to make money. It could lose money indefinitely. It has the power of the public purse behind it. Now, that's not to say that the Fed is nefarious or is going to be ruthless or reckless with the public funds. But there is no doubt, without the discipline of consequences, that there is going to be a difficult situation associated with making credit decisions by the central bank. It's a serious problem. It's a reason why we have always argued that central banks must be independent of both government and political processes, but also private businesses, where we are not, central banks are not allowed to take exposure to losses. Now, the Treasury is backstopping the Fed's losses. So I'm quite concerned about that, and I don't think it makes for efficient capital allocation going forward, and I would caution against making this permanent.
All righty, another line of questions deals with the potential for inflation. With all the money that the Fed is pumping into the economy right now, do you view a potential resurgence of inflation as a strong possibility or risk?
Yes, I certainly do. I think that there is so much in terms of stimulants and in terms of financial resources being spread around the world economy that I'm quite worried that once the economy restarts, that this will fuel an inflationary bubble. And so I am concerned about that. I have a colleague, my two colleagues, Professor Loren Wu and John Hua of our department, who also have a model that came out in a top academic journal in 2018. And they have, and they look at inflation forecasts. And I asked them to update their model as well. And they updated their model for our current situation. They are not forecasting inflation to exceed 2% until the year 2024, but their model is predicated on the connection between monetary policy and inflation. That is, that when there's a fear of inflation, the central bank tightens monetary policy, raises interest rates, and vice versa. We have not seen that. That connection has been broken over many years, and certainly over the pandemic. So I'm not so sure that, like I'm worried about the predictive power of our model, I'm also worried about the predictive power of their model as well.
Do you think that the fiscal approach that we're taking now is going to end up flooding the economy and making the inflation problem worse in the future?
Yeah, I think at this point, I think that the Fed, the central bank, has become the fiscal authority as well. I don't think there's really a distinction between monetary and fiscal policy anymore, essentially, and that's because the central bank and the Treasury is funding business on a wide scale basis. It used to be that the central banks were lenders of last resort only to the banking system because of their special importance to the operation of the macroeconomy. That's not true anymore. So fiscal and monetary policy are all the same. They're open, the spigots are open full blast. If there's ever a connection anymore between aggregate demand and inflation, we'll see it. If not, then we won't.
Let's focus for a moment on the deficits that we expect in the federal government, the state governments, the local governments. Those are ballooning.
Yeah.
Who's going to end up paying for that?
Yes, well, you and me. And so certainly politicians don't like to tell us that the bill will be presented, but it will be. I think that the question is in what form. So, of course, it could be in the form of taxes, which there's a great aversion to raising taxes. But it also could be in the form of what economists like to call the crowding out effect. So here's another picture. So, so what do we mean by the crowding out effect? What the crowding out effect is essentially when the government funds or lending borrowing capacity crowds out private sector borrowing capacity. And when we see that the government floats huge amounts of treasury securities in order to fund the deficit, well, that means that investors who buy those treasury securities aren't buying corporate bonds or stocks or other investments. This is a picture actually out, and it has to do with the creditworthiness in the private sector. So this is a picture out of a company that I like very much. They're called Kamakura. They do credit risk analysis. And this is updated till May 1st, 2020. They analyze, this is 40,500 companies throughout the world. And they examine which companies have a high risk of default. And what they found, and you could see, this is the heat map going back to 1990. Here, this peak, of course, is the financial crisis, where we saw that the number of firms throughout the percentage of firms that were looking at a high risk of default went up above 40% of all firms. And so that was the highest that this has ever been, this indicator. Right now, we're at 31.3%. So we are lower than the peak, but we're pretty high, meaning that there is quite a bit of credit risk in the system. Lots of companies that may go bankrupt or have problems repaying their bonds or other loans. This is a slight improvement from March. It was even worse in March, but it is very high nonetheless.
It's very high. I think we're close to closing, and I think there's probably time for one more question. This is really a little different. This is from chat, and it says, as a layperson who does not have deep knowledge of financial markets, should I follow Wall Street or Main Street in forecasting the next round of recovery and economic boom?
Okay, I love that you asked that question, because this is, to me, the problem with the financial press. And this is what our model is telling us. If you think that there is a difference between Wall Street and Main Street, you're wrong. All of those that try to tell you, well, Wall Street, nothing real is produced on Wall Street. All they do is push paper around. Nothing is real there. It's Main Street that matters. What, if anything, if you believe anything out of this last hour, and if you believe our model at all, it's to show the connection between Wall Street and Main Street. When Wall Street gets sick, Main Street gets sick. Main Street and Wall Street need each other. They are interrelated. And the health of Wall Street is reflected in the health of the macro economy, which is Main Street. I want to see both come back to health. I want to see all of you healthy. We should all get out there with our masks and our gloves and our social distancing, but I will start the world. I want to get on.
Thank you very much. There are a lot of other questions, but I think these are enough for this setting. I want to thank you, Linda, enormously for your very engaging answers to these questions.